Okay, so we've looked at a change in principal, and we've looked at a change a change in estimate. Now we need to look at errors. Now we're not going to look at a change in reporting entity in this course. That's more of an advanced accounting topic, so we're not going to talk about that. So we've talked about changing methods and how we have to restate, or excuse me, changing methods, changing principles, and how we have to go back and restate prior years. We've looked at a change in estimate that does not require us to restate prior years. Now let's look at some errors and how errors impact our financial statements. So during 2018, WMC Corporation discovered that its ending inventories reported on its financial statements were misstated by the following amounts. In 2016, we were understated by 160,000, and then in 2017, we ended up being overstated by 230,000. WMC uses the periodic inventory system and the FIFO cost method. Now again, we're not changing methods, we're not changing estimates here. We have errors. We actually made an error in the reporting of our information. Required, determine the effect of the 2016 errors on retained earnings at January 1st, 2018 before any adjustments, ignore taxes. So let's go all the way back and let's look at each year. So let's start with 2016. Did the error impact our beginning inventory in 2016? Absolutely not. There was no effect there because the error happened in 2016. Now, was the error on purchases? No, it was on ending inventory. What was wrong with our ending inventory that year? Well, ending inventory was understated. By understated, we means we reported less than we actually had. So if we understated inventory, what happened to cost of goods sold? Well, sometimes it helps to think about the journal entry. So remember, when we record cost of goods sold, we debit cost of goods sold and we credit inventory, right? So if we understated inventory, that means we reduced inventory by too much. That means our cost of goods sold would be too high, okay? So we would have overstated our cost of goods sold. Now, how does that impact our revenues? Well, it doesn't really impact revenues at all. Our cost of goods sold, though, would be overstated, as we've already talked about. If cost of goods sold is overstated, what's wrong with income? Well, if it's an overstated expense, that means we reported too much in expense. And since expenses reduce income, that means our income would be understated. And if income is understated, what is wrong with retained earnings? Well, if we report too little in income, we are also going to have understated, retained earnings. So see how this one error impacted us. So our ending inventory is understated by 160,000. That means our cost of goods sold is overstated by 160,000. That means we understated our income by $160,000 that year, which in turn impacted our retained earnings. Now, how would this error impact 2017? Well, that means in 2017, our inventory at the beginning would be understated. What about our ending inventory? Now, right now, it's only saying what's the 2016 errors effect on 2017. So we're only looking at this. We are not considering the fact that in 2018, we discovered an error in 2017. We're talking about the 2016 error. Our beginning inventory would be understated. Our ending inventory should be okay. Because when we go this year and count our ending inventory, hopefully we do it correctly and don't make the same mistake we did in the prior year. So this year then, our cost of goods sold would be understated. Basically, we would correct this 160,000. So we would be overstated here by 160. Assuming we counted correctly here, then here we would be understated by that same 160. So it would fix itself in the next year, assuming we made no additional errors. Again, how would that impact our cost of goods sold? Well, our cost of goods sold would be understated. That would make our income for this year overstated. And then what would happen here? Well, that means it would correct our retained earnings. Hopefully that makes sense there. Do you hear my dog's having a dream? So she's barking. But anyway, so by understating our retained earnings by 160, we correct it here by overstating our income. So we actually would end up correcting retained earnings. So with nothing else, if we make no future mistakes, it will correct itself through the physical counts, because in periodic system we physically count our inventory. And assuming in 2017 we counted it correctly, it would automatically fix. So it would be an up and down between years, but it would fix itself. So we wouldn't have to actually make any adjustments to retained earnings, because retained earnings as a total would be corrected. Okay? So that leaves us with the 2017 error. How would we find the 2017 error? Well, in this case, beginning inventory was no effect. Remember, it's corrected itself as of 2017. So it's no effect. Now, our ending inventory in 2017 is overstated by 230. So it appears we make another mistake. So we are overstated by 230. If inventory is overstated, that means our cost of goods sold is understated. In other words, we didn't write out enough inventory as sold, so therefore we have understated our cost of goods sold. If our cost of goods sold again is understated, what happens to income? Well, anytime an expense is understated, income is overstated. We did not take enough in expenses, and that would mean our retained earnings is overstated. So when you're thinking about errors, that's what you've got to consider is, wait a minute, was the position overstated or understated? We have to be careful because revenues and expenses flip-flop. If a revenue is overstated, income is overstated. If an expense is overstated, income is understated because of their impact. So let's say that again. If revenue is overstated, then income is overstated. If expenses are overstated, then income is understated. Okay, so really it's the reverse impact, depending on whether you're dealing with revenue or expense. So now, how are we going to fix this 2017 error in 2018? Well, to fix this, we're going to have to go back in and we're going to have to hit retained earnings. Now, you're like, wait a minute, why are we doing this now? Because we want to fix retained earnings so that we do not mess up this year's income. Oops, I put that in the wrong, I just realized, sorry about that. Let me move that down. I was in the wrong cell. Our income currently for 2017 was overstated. So if we just let it fix itself, that means this year our income would be understated. So what we want to do is fix the issue so that way in 2018 at the end we do not have under or overstated. And hopefully we find the issue with why our inventory here keeps being over or under. You're like, wait a minute, how could that happen? Well, it is possible. When I started my career in accounting at one of the largest banks in the country back in the day, well, it's my second job in accounting, so I didn't start my career there, but it was my first, well, we won't talk about that. But anyway, when I started, they were out $18 million. They had errors, not fraud, errors of $18 million in one of our divisions. Granted, we have $1.4 billion in balance sheet, but an $18 million error is a substantial error to have to correct. So errors do happen. It's not necessarily anybody's direct fault. It's just a system issue, and that was definitely a system issue. So we had to resolve that issue. So keep that in mind. Errors occur constantly. So in this case, the fact that we keep having inventory errors, we really need to examine the processes, which is what we did at the bank. We examined the process, and then the next year we were not out by any amount. Well, let me rephrase. I think it was like $200, but that was just translations and pennies. That was no big deal. So we did have a little bit of a break, but that was just normal fractional penny errors, not, $18 million. So anyway, as you go through, errors happen all the time. The important thing is to understand when an error occurs, am I overstated or understated, and how do I correct my issue? Okay, so if my inventory is overstated, I need to reduce my inventory. That's how I would correct it. Now, why don't I hit cost of goods sold? Well, remember, 2017 cost of goods sold would have been cleared. So anytime we're correcting the error on a temporary account, we typically have to hit retained earnings because that's where that balance currently sits in 2018. We do not carry forward revenues and expenses from one year to the next like we do our assets or liabilities. Okay? So hopefully that sort of gives you a ground, just basis for understanding over and understated positions and expenses and assets and how to correct those errors. Again, this would have to be handled retrospectively. We do have to go back and restate prior years when we create financials. I hope you have a wonderful day.